Now, just a quick mentioning. Nobody needed to know that. Just a quick mentioning of our upcoming events. Next Thursday, we are hosting our Young Executive Circle for our 40 and under crowd at the Graduate in Palo Alto. On September 5th, we have our Female Executive Circle, once again at the Roger Bar in Mountain View. We have something new here that we're trying out at ACGSV, and that's our Family Office event on September 13th. On September 19th, our next monthly event will be covering the future of finance. CFOs share their perspectives. We're very excited about this one as well. And October will be crazy busy for us, starting off with our inaugural conference, the M&A Tech Connect, October 1st and 2nd at Levi's Stadium. If you haven't purchased your tickets to that one yet, don't wait any longer. It's going to be an amazing event filled with high caliber content, first class networking, and lots of other gems like a tailgating opening party for the reception. So for all of our upcoming events, check out our website and register early. Now it is my pleasure to introduce you to Stephanie Thomas, the chair of the private funds group here at MoFo. So Stephanie, please.
Thank you. Hi, everyone, and welcome to Morrison & Foerster. It's nice to see all of you. MoFo is a global law firm. We're headquartered in San Francisco, and we have 18 offices across North America, Asia, and in Europe. We specialize in a wide range of industries with expertise in areas such as corporate law, litigation, intellectual property, technology transactions, and regulatory affairs. As was mentioned, I chair the private funds group, so I do everything funds related, everything from venture capital funds to private credit funds, real estate infrastructure, sort of the full gamut. We represent large funds and first-time fund managers. So with that, I will turn it over to Nick, who's also a member of the private funds group.
Thanks, Stephanie, and thanks everyone for coming. Thank you, ACG, for putting on this event. This is our second year having it here. See a lot of familiar faces, including Helen on the panel. We're really excited to have you here and have this mid-year capital outlook. As you may notice, there's only 4 of us. Unfortunately, Jeep could not make it. She sends her regards to everyone, and feel free to reach out to her with any questions, and she hopes to see everyone at the next event. But what that means is more time for us to speak, and also hopefully more time for questions from you. We really want this to be interactive, so definitely think of questions. We'll have some Q&A at the end, but if anything comes to mind, just let us know. Before we introduce the panel, I'll just introduce myself. Like Steph, I'm a private funds lawyer here in Palo Alto. Prior to being here, I was in Asia for a number of years, and then I moved out here last year. I focus on the full gamut of funds, from VC to growth to private equity to credit funds and the like. And with that, I'll let the panel introduce themselves. Maybe Vishal, we'll start with you and then just go down.
Thank you, Nick. My name is Vishal Verma. I run a single family office based in Los Altos. Is it okay? Can you guys hear me? We've been around since 1998. Basically, what I always tell people is, one family made a shitload of money. My job is not to lose it. So, and there's Ahmad also there, whose job is not to lose it as well. So, just on the personal side, before running the fund or running the family office, I was an entrepreneur, a tech guy. Grew up in Los Altos. I'm a local baby. Well, not a baby anymore, but. We've invested into 16 different venture funds over the last 28 years. That includes some of the big guys like Sequoia, Lightspeed, General Catalyst, Kleiner, General Catalyst, and some of the emerging managers, including Joe Montana's Liquid 2. I like to call him Beyonce's husband, who might be surprised or do the surprise in DNC today. Anyway, so we invested into Marcy, which is Jay-Z's fund. So kind of all over the spectrum in terms of some later stage companies or later stage funds, and also some early emerging managers. And we do also do direct investments. We made 30 direct investments that haven't died yet. Hopefully they won't. And I'm looking forward to the panel with us, hopefully with an amazing future of public markets exits.
Thank you, Michelle. So it's very hard to go after Michelle with extraordinary background. My name is Helen Lee. I'm a managing director of Needham Company. So a full service investment bank help companies to raise capital and advise them on M&A transactions. This is my 14 years at Needham. Before that, I worked for semiconductor industry as an engineer for 7 years. And at Needham, I continue my path on semiconductors, so mainly serving the semiconductor industry. So very excited to be here. And I was here last year, and great to see many familiar faces, and very proud and excited to be part of the conversation.
Good evening, everybody. My name is Chris Brown. I am the market president for BNY Wealth for Northern California. So what does that mean? It means I lead a wealth management team of about 30 people out of Menlo Park and San Francisco office, and we advise high net worth and ultra high net worth individuals. So if you make a shitload of money, but maybe not enough to start your own single family office, you might engage a firm like ours.
They're the best one in town.
Thank you. Bank of New York sits at an interesting place within the financial ecosystem. And also, let me just frame that a little bit, because I think it might help you understand some of the perspective that we bring. Bank of New York is the largest global custodian of assets. We custody 50 trillion of assets. So we are very much in the business of the plumbing of the financial markets infrastructure. We're also do most of Treasury clearance for the US government. We're very much integrated into the US economy. We're mostly a B2B business in that we mostly serve other banks and financial institutions. And where I sit within wealth is the only outlier of that, in that we work directly with individuals. But I think it positions us. We also have a large investment management business, none of which is called Bank of New York. It's called things like Dreyfus and Mellon and Newton, all these other subsidiary businesses also in the investment management business. I only provide that just to give you some context for comments we'll make. I think that from my seat, we tend to be talking to clients about things like interest rates and the macro environment. So I'll talk mostly about that. And I think our panelists probably have a little bit more insight into the day-to-day, on-the-ground machinations of all of that.
Thank you, everyone. So as you can see, we have a really diverse panel that covers different areas of the market, from public to private and in between. So Helen, I think we'll start with you and look at the public markets. So how was the IPO market been recently, since you were here last year? And also, how did recent IPOs that you worked on fare?
Thank you. I also asked the exact same question a year ago. And
very creative.
and at that time, you know that 2022 and 2023 were very challenging years for capital markets. So basically, IPO window is closed, no transactions. I'm more focused on technology. So, all my, the deals I'm talking about is from technology transaction perspective. At that time, I was saying that people are optimistic about the market coming back. Unfortunately, that didn't quite happen, but hopefully that leaves more hope for this year. So I'll be very careful what I'm saying this year. So I'll start with a recap for, what the situation is this year in terms of IPO markets. So it's definitely better than 2022 and 2023, but we don't consider IPO windows open yet. So far this year, we have 8 tech IPOs. And I would say out of the, here, let me slide in 10 seconds commercial for Needham. Out of 8 transactions, we underwrite 7 of them. So that put us in terms of ranking number 1 of IPO underwriters for this year. And the 8 IPOs that went out this year, actually, if you look at actually, most of them are priced pretty well from a transaction perspective. The average deal size is close to $500 million. That's actually more than half billion. Average size is $545 million. And market cap wise, only 2 out of 8 companies are below $1 billion. So the rest of them are, from somewhere, $5-6 billion. And I'll just run the names. I guess you're probably very familiar with the names with Rubrik, that's a cybersecurity company. one stream that is corporate performance management company, and on Ibotta, which is a market company managing the cash back, Reddit, social network company, Astera Labs, which is a semiconductor PCIe retimer company, Silvaco, which is an EDA company. Tempus, this is AI-enabled precision medicine company, and the last one is a biotech company, Ativa, which is very rare. For biotech, we haven't seen deal for a long time. So if you look at the IPO performance, I would say most of the deal actually priced on top of the right range or even above. Using Astera Labs as example, the original deal, the price range was $27 to $29. So we're able to move it to $32 to $34 during the roadshow, and eventually priced at $36. Not too long after the IPO, the stock price went to $95. It came back now more reasonable to $40, but still above the IPO valuation. And I would say even the IPO valuation is actually a quite rich valuation. It's nothing like a discount. So I would say that from pricing perspective, the market is I would say there's a lot of investor demand. So an observation from this is we feel like the reason there's no IPO today is not because there's no demand or there's no cash in the market. It's more a lack of issuers, and the companies are very hesitating of getting out, and for several reasons, like people worry about uncertainty, timing about election, and what it does to the market in terms of the industry, like impact the company's revenue, affecting the visibility and certainty in the next 6 months. Because if you're taking a company public, the last thing you want is to miss the first quarter, right? So you only do that when you have very good visibility into the next, if not 6 months, maybe nine months, or 12 months, even longer period of time. And put things in perspective, to look at 22 and 23. So for both years, the total capital raised for IPO are only $1 billion for each year. This year, we have raised over $4.4 billion. But if you compare with year 2021, which is the highest IPO year in the past 10 years, there were 167 deals, and total raised $56 billion in 21, and 2020 was less than that, but still 92 deals and raised $36 billion. So, definitely we're not going back to like 21 to 2020, but still, I think we're on the path of recovering. And so, several observations. One is I think there's still strong demand from investors' perspective. The second one is what kind of deals are favorable to investors right now, since there's clear trend of AI. That's the buzzword for this year. I think most of the deals that get priced this year, priced well this year, have a certain element of AI in perspective. I think it'll be hard to label a company without any AI to AI company, which investors were easy to tell. But the true AI story did get a lot of interest from the market. So the now transition, what's going to happen for the rest of the year? And again, it's very hard to predict the future. Now we can definitely see the headwinds of being an election in the middle of the way, right? So the people trying to avoid the uncertainty, and we do have deals in the pipeline trying to get out before the election, but it's a pretty tricky timetable today. So we'll see how that pan out. But a lot of people tends to wait until Q1 next year. The good news is people are expecting the reduction of interest rates will increase asset value for equity, right? If that happens, that potentially can hopefully, bring more energy to the IPO market. So our capital market team did a very interesting survey this year, asking the active IPO investors what their expectation, right? So, and then we did get more than 25 responses from institutional investors. And in terms of when the IPO market will open, over 50% people will say next year. Majority people saying Q1 next year, and probably like 23% saying that's going to be Q2, but nobody is saying beyond Q2. So people do anticipate first half of next year to see the market come back. And we ask about, the profitability, right? So what is your expectation on company's profitability? At the time of IPO, or most of the investors say, majority, over 90% will say at the time of IPO or within the first 12 months. anticipate to see the profitability, of the company. And we did ask the investors, so what will be the growth rate that they're expecting on the companies? So, majority of the investors, over 70%, is saying they would like to see a more balanced growth rate over profitability. If people are familiar with the software industry, there's a rule of 40, right? So which means the company growth rate plus EBITDA margin higher than 40%. So it's going to be a balance for us just focusing on the growth. And the last question, and the last investor is like, how many meetings do you anticipate the company conduct before their IPO, right? Before the investor places an order on IPO. So the question is 2 to 3. Most of the people anticipate at least 2 meetings with investors before the roadshow. So we do have a lot of open questions asking people, the investors, what they like to see from the company, what they hate to see the company. Have a lot of detailed answers, and people interested can send an email. I'm happy to share the reports with you because this is the first-hand information from the institutional investors actually investing in the IPO. So I'll pause here for a second to see any questions, comments.
Helen, I have a question. Actually, a lot of comments.
Sure.
First of all, you said next year. I've been in this investment game for 30 years. They always said next year.
Next year.
They always said next year. So is it, the election is a big part of it, of course, right? The Democrats come in, more taxes, more regulations, Trump comes in, it's chaos, whatever is going to happen. But companies that, at least the funds that I put money into, they're just getting, these portfolio companies just getting bigger. By the way, I'm an investor in Rubrics as well, so that was a happy day. However, Lightspeed might not distribute that because they own 35% of it. So I'm not a happy camper until they decide to. Anyways, that's my problem. But is it, the question I had was, these companies are getting so big, right? Stripe is doing 8 billion in revenue. Netscope is doing 500 million. I'm sorry. So example after example, ThoughtSpot's doing 350, BetterUp is doing 400. Companies we've never heard of, but they're all doing amazing. Why aren't they going public? I mean, they are meeting the 40%. Yeah. Is it, I made a comment, which I shouldn't have, but I'm gonna repeat it. Is it because the Dark Vader, which I call her, is Lena Khan, is she putting a lot of restrictions on IPOs and acquisitions? For instance, the Wiz deal that happened or didn't happen, right? Everyone heard about the Wiz deal, right? 23 billion, woohoo, rah. We were investors in that also. We were, Ahmad and I were going to take a trip to Hawaii, but we didn't. Because we don't have cash right now. And by the way, it's been a dry 3 years. And 2021, whatever went out public, it's all bullshit. Right? I mean, they did these SPACs, which I call fraudulent companies. But anyways, that's a different conversation. I'm sorry.
No.
Did you? You did not say there's any disclosures here before.
No, we're good. But Helen, what do you think is the reason why these companies gotten bigger and not IPO? Why are they still waiting? What are they waiting for?
I think it's a valuation challenge because if you look back in the last 36 months, there's really not ideal market sustain such big valuation, right? So a lot of companies actually, like Reddit is a big discount at IPO, right? Other companies, I think I'll say 70% of the companies up around, but Reddit is a down round at the IPO. That's a challenge for the gigantic companies you mentioned.
So that's the discussions that we have in the closed doors. Is the ecosystem of Silicon Valley? I know that's not the question.
That's okay.
But is the ecosystem of Silicon Valley just broken because there's so much money supply which is sitting? And I'm sorry, I'm taking your job too.
No.
Is the money supply just so much there that they're just throwing money as a convertible or as a note or whatever they are, and just to take money and then it doesn't matter their valuation. For instance, perfect example, which you mentioned, Instacart was done at 46 billion. Now it went out at 10, sitting at 6 or 7, right?
Yeah.
So, but there's in the private market, let me get to my question. In the private market, because there's only a handful of people making these valuations decisions, is it that kind of the market is broken just because these guys just want to get into And this question should be to VCs, not to you, actually.
Exactly.
So,
Exactly the question to yourself. That's
exactly.
right?
So I've been investing in later stage companies valued at 8 billion, 9 billion, 2 billion. What the heck? Mistral was done at 4.5 billion, 5 billion, right? A year and a half old company. A company called Skilled. I don't know if they're your clients or not. Just came out of Carnegie Mellon. Two PhD students at 1.2 billion raised 300 million.
Right. Well, I mean, I was going to say this, that, you know, in the private fund space, there's just a lot of capital there. You don't really need to go public, and there's a lot that comes with going public. So I think there's a balance there as well.
Can I suggest a corollary to that, or a related factor to that, which is that, so first of all, I think part of this is a hangover from the bubbly days of 2020, 2021. But the second important part is there's so much liquidity being offered to founders and early employees today that just wasn't the case 10, 15 years ago. And so if you want to go buy, if you're a founder of a successful company and you got a $5 billion valuation and you need to buy a house for $10 million to live in some fancy neighborhood, it's there. It just wasn't there previously because the ecosystem existed.
So the ecosystem is getting, or is it just the flow chart? You have the entrepreneurs, you have the VCs, and then you have the LPs back here. Are we all getting too greedy? Like Michael Douglas said one time, right? Greed is good.
Yeah.
So
that's
good?
Yeah. That's a little too philosophical for the mid-year capital. But this might be a good segue to Christopher. No, but these are. But let's, you know, you sort of straddle a lot of different areas. How are you advising your clients?
Yeah.
To position themselves given the current market and for the rest of the year, and also looking forward?
Yeah, why don't I mean, in terms of how are we positioning ourselves, I would say we oftentimes have a strong market view. Right now is not one of them. We sort of have a very consistent view of the rates, like rates on a go forward basis from where we are today. Kind of generally expectations are in line with our own. So I don't think I have anything particularly exciting to say along those lines. But let me just tell you a little bit about our view on the economy and where we think things will go, both in terms of rates, which we spend a lot of time thinking about interest rates and direction thereof. I think like everybody knows this, so like fly through it. But you know, we had a global pandemic. We dumped a bunch of money in. Everybody changed their buying behaviors, right? So if you were going to go to Italy, instead you bought an Italian couch. That led to, we also didn't have people wanting to show up to work. So we had a bunch of supply chain issues. Voila, inflation's raging. All of a sudden, we get a big bubble for the period that we have zero interest rate policy, and a ton of money that we throw into the economy. So people are speculating on all sorts of stuff. Plus, there's some behavior issues here, right? People are sitting at home and kind of buying up whatever asset they think is most interesting for the moment. That eventually, you know, all that fun and partying does cause a hangover, which I genuinely believe some of this is hangover. When you draw demand forward, there's ultimately a cost to it. We end up with this massive inflation rates that we hadn't seen for, I mean, really, I hadn't seen in my lifetime. And so we hike rates extremely quickly as a result. And what is that hammer to start? It's the longest duration assets. So we had a recession in Silicon Valley. If you were here, right? We didn't have a recession broadly, but certainly if you were here, there were layoffs. And if you worked in tech, you were worried about your job. And now that's behind us. The most amazing thing about what's happened, sitting where we are today, is if I had told anybody in this room who was paying attention on January 1st of this year, we won't cut rates until, you know, maybe in September we'll have a rate cut. The market will be up 18, 19% on broad market equities. We wouldn't have believed it, right? Especially in the context of two ground wars in the broader global sphere. And yet the global economy, and particularly the US economy, has been so incredibly and just gravity-defyingly resilient, right? The consumer continues to buy, continues to perform. And here we are today. We've never had a period where where we had a inverted rate curve, where we've hiked rates this quickly, and we've achieved this proverbial soft landing. But that would seem to be where things are headed. Now, are there cracks? Are there concerns? Yes, but the famous saying is the market always climbs a wall of worry. And sure, there are always things to watch. There's always things to be concerned about. But our general view is that global growth and US growth has defied higher rates. You look at what economists have done, and I think economists in some ways are always projecting, but also just responding to what's already happened. But many have upgraded their global growth predictions. We have true household income growth in the US and in Europe of 6% plus. And if rates are 2.9%, kind of we're getting close to target-ish at least. And our view is pretty rosy. We think we enter into sort of a 1990s style economy where we have savers earning real rates over inflation. And we anticipate we'll get a rate cut this year in September. I don't think, well, we'll learn a lot tomorrow from Jackson Hole. And then probably one more before year end. And then we end up in sort of this 200 basis points above inflation. If we get down to 2.5, like between 2 to 3% in 2025, that keeps us at like a 4% Fed funds rate. And the economy just kind of continues to chug forward just in the way it has. It's a kind of a boring outlook because it's so benign. And I think there's like plenty of things you can always point to be scared of. But the rest of the world is already cutting rates. I think we're likely to follow, at least in small step by small step. But the world is just changed. We're not going to go back to 2008 until recent memory where rates were super low. That's unfortunate for me because I bought a house recently and my mortgage rate is way too high, unfortunately. But it just hasn't slowed consumers down as much as you'd think. Big companies have been the major beneficiaries of it, right? Because big companies locked in long-term debt, small companies have struggled. And I don't think we can I do think we're in restricted rate territory. We can't keep rates where they are today forever without feeling economic cracks. But if we bring things down to, for those of us who've been around and investing for long enough, earning real money rates in the 4% range, that's probably an okay place to be 2025 and beyond. So that's my crystal ball. If I had a real one, I'd probably be in a different line of business, but that's our view as an institution.
And just to follow up on that, you mentioned US and Europe, but what about outside? I don't know to the extent you advise on that, but how about Asia, where I've had a lot of experience, or other economies? Are they going to have investor interest, or are investors really interested in the US and Europe, because that's where the growth is?
Yeah, the question on China, which is like the major question, right? Like I'm fairly optimistic, or reasonably optimistic on Japan, I'd say. China, I think it's still too early.
Yeah.
Now that's kind of the consensus view. I'm very consensus today. That is not me by personality, I promise. But it just feels early. Now there's certainly deals to be had for people who are on the ground and operating and can find the true deals and understand the market. But if you're a broad markets investor, like kind of investments we do, I still think it's, there's still a number of things to work out.
So Nick, I can talk a little bit about India.
That would be fantastic.
We've been investing in India since 2008. The first go around, we lost our shirt and our pants, I guess. And so we came home broke. And India, John Chambers said this in a conference one. India's like having your grandchildren. You love it, you kiss it, but you give back to management. However, the only reason I think India is in a good position to grow is because someone told me this in Washington. Then India is the right counterbalance to China. So all that money supposedly that is going into China will be going into India, and you see a little bit of that, right? In terms of Apple's manufacturing, even though it's 5% of the next generation iPhones are done in India, but and there's other kind of manufacturing. They're talking about semiconductors. Consumers are growing like crazy. I think the tech jobs have gone up to 25, 30 million tech jobs. I forgot whatever the number is. So I think India is an amazing place to invest for the next not just decade, maybe century.
And that actually corresponds with what I'm seeing as well. I spent a lot of time in Asia. There's always interest in China, but it's a difficult environment, and a lot of people are looking for that growth in India. And India seems to have had some successes recently. So we've seen actually India has been one of the areas in Asia where you've seen some funds being raised.
But we Indians are difficult too, so.
I'll leave that to you to make. Well, Vishal, sticking with you.
You sure you want to do that?
Yeah, I think it's going well so far. So, you just have a really interesting perspective investing in so many funds, and so I think it'd be very interested to hear from you from the LP perspective. How do you see the fundraising environment? How has it evolved over the past year? And where you see it going end of this year and into next year, really from the private markets perspective.
So I'll start with some data. If you kind of look at it from 2020, I think it was, the VCs raised about $160 billion of capital. And when you said the IPOs were only 50 billion at the high time, that looked kind of out of sync in terms of how much VCs are raised. In 2021, because the market was crazy, everyone was sitting on their butts on their sofas, watching CNBC, buying stocks. We were all wealthier than we were probably today. And the VC class raised about 300 billion. And we can debate, is it 320 or is it 310, whatever, rough numbers. And you must know the data as well. And then the next year, 2022, they raised 160 billion. And if you take 21 and 22 out, they're flat. And this year is probably about 160 billion plus or minus as well. So there's still amount of, in terms of money supply, which is in the system, is so much money which is in the system. Like out of 16 funds, but actually, let me come back. But they're investing to the same stuff. Right? I think I forgot what I told. I have SpaceX stock through like 8 VC firms. I mean, that's how much more stock do you want of SpaceX at $220 billion? So that's one point. Second point is the bigger, the more established the funds are, the easier time they're having relatively to raising money. So for instance, General Catalyst, which raises 2-3 billion, historically, last year they closed 6.5 billion. NEA closed 6.5 billion. Lightspeed in 2022 closed 7.25 billion. They're probably going to announce, which hopefully this is off the record, they're going to raise about $10 billion by Q1. So now you're talking about real money. A billion here, a billion there. That's a lot of money. So so at the end of the day, everything depends on Helen, because if there's no exits, there's no liquidity. People like me are not going to reinvest because we don't have money. Helen, it's all up to you. But at the end of the day, the markets are great. And this is historically, no matter what it is, you have 100 companies that are raising money like crazy, and the 101 to a billion is surviving, if not starving. So the super duper entrepreneurs and CEOs can raise amazing amount of capital. What else?
What are you looking for when a new fund comes to you? What are some of the things that you're focusing on and that you found attractive?
Okay. So that's a good question. So I actually look at only kind of one main thing, is what is the proprietary deal flow that they have that I can't get access to, and that's the reason I want to give my 220 away. So if you look at the funds that I mentioned, they're pretty good.
And how about smaller, like emerging managers? Are you open to investing in those type of funds? Are you really looking only for the big ones?
We are looking for emerging managers. However, we do not do first-time funds, so they have to be in multiple vintages. I totally get it. The first funds always kick ass. They're the best, amazing returns of the fund in the history of that fund. But right now, there's 10,000, 5,000. I forgot how many thousands of single GP managers are there in the United States. So I'm sure you have the number better than I do. So it was between 5 and 10,000.
It sounds about right. Yeah.
So now it's like picking a company. Is that the Google or is that?
Right. And it's a lot. Yeah. But at the same time, you might be able to get away from the diversification, that all the big, you were saying that how many funds you need to invest in SpaceX.
Yeah.
And so some of these smaller managers might be able to have some sort of
Yeah.
differentiated.
So I think folks have done well. If everyone knows Ron Conway here, the Super Angel, right? He has a simple philosophy. I invest into Google. When the people leave Google to start new companies, they go to him. And that's the reason people put money with him, because of the deal.
So I have a few general questions, but at this time, if anyone has any questions, you can raise your hand. I think we have a microphone over there. Otherwise, I'll continue asking questions to the panel, but feel free to jump in and ask questions. All right, Jonathan.
I could talk really loud.
That's good. Yeah, go ahead.
So I'm curious, Ishal, it sounds like you were saying there's kind of or maybe not too much, but a heck of a lot of money flowing around with VC, or certainly relative to actual investment. So is the issue that there aren't enough startups, or there aren't enough good startups, or everyone's just choosing to invest in the same startups, or is it a supply side issue? There's just too much institutional investors going in now to VC funds.
So at least what I've seen is the institutional investors that put money into venture capital firms, they're doubling down and tripling down. You heard the saying, when the market, when shit hits the fan, money goes to the flight to safety.
You're good.
The flight to safety is in the big known quantities, right? That's the reason you see the Mag 7, the Googles, the Microsofts, because everyone's putting money in it. Right, so everyone who's have access to the big brands, they're putting money into the big brands. And I asked one of the GPs, who's a buddy of mine, like, why'd you raise $6.5 billion? That's a lot of money, man. He's like, just because we could. So, and 2% of $6.5 billion is a lot of money. So it's a lot of money.
So obviously, a big theme of this year has been AI. I'm sure a lot of people are sick of it. We sort of had a lot of interest in it. Some say maybe that's calming down, but I'd be interested to hear from each of your perspectives and your different vantage points in the market, how AI has impacted what you're seeing, and also where you think we are in the overall trajectory of AI and where it's going.
For me first,
anyone jump in. Maybe we'll start with Christopher and then
So I would say AI drove a lot of it, in terms of broader markets, drove a lot of the optimism early in the year, and is partly responsible for the high multiples that we see stocks trading at. I mean, it's pretty shocking that we have such high rates, and then the market's also trading at 20 times plus. That's a surprising thing to happen, and certainly reasonably unprecedented historically. That being said, I do think that from a public markets perspective, the optimism around all the potential benefits is still there, but now there's a bit of a show me, right? So this can't just be a place where money is spent and we don't see the benefits in terms of profitability. And so I think that's probably where the market is on a go-forward basis, at least public markets, and I'll let others who know the private markets comment more intelligently than me. But on the public markets basis, I think there's going to be a lot more scrutiny on, okay, it's great that you're doing something in AI, you're spending some money on it, but how is that translating into your actual bottom line?
I'll say from my observation, we do raise capital both in the private market and the public market. So I think for both markets, the company get good valuation, good traction. Most of them are focused on AI. For example, just AI accelerator, right? So this has been, you and I will talk about that. People have been doing this for over probably 10 years, right? Or at least in the past 6-7 years, there are a lot of activities around that. And you'll see that there are several high flyers being able to raise like 300 million, 200 million, like a company like Transtorrent, which is very different category than like non-AI semiconductor companies. But on the other side, I think you see similar phenomena on public market as well. But what associated with the high valuation or high multiples is expectation. So you do have to deliver the performance and the growth. So as a public company, if you miss the expectation, so that will put into the penalty box. So I do see, there obviously the increasing risk, and people talk about there's a bubble in AI. I think it's debatable. I think from long-term perspective, we're at the early stage of deploying AI in terms of the impact this could have to the human society. But in the short term, there's definitely a lot of hype in AI valuation.
Yeah, I think AI is here to stay, right? I mean, Everyone who can spell AI is an expert now, right? So I'm sure Imad had a tough time spelling AI, but it was okay. Too many snigger.
You
Yeah.
could use ChatGPT.
So I think AI just made me look smarter on like on LinkedIn. I do a lot of posts. It makes me like I'm Shakespeare, flowery. It's not none of that language is me. Should I have disclosed that? Oops. But to Chris's point, I think it's for these big hyperscaler companies, you need to overspend right now because you do not know which sectors is gonna be the winners, how you're gonna make money. They're learning as well in terms of what is the right unit economics that everyone talks about in terms of the AI deployment and spend. And that's another reason the downturn happened, what, 2 weeks ago, 1 week ago, when Google came out and said, oh, we don't know what we're doing, but we're overspending, right? That's what they said. NVIDIA hit $90. I hope everyone bought NVIDIA at $90. Actually, Chris, what should we do ahead of the earnings? August 28th.
Wish I could tell you I knew.
So another obviously big important event that's been touched upon, and we have the DNC tonight where Kamala Harris is going to give her speech. But how do you guys see the impact of the elections? How is it affecting things now? And once we finally have some certainty there, how do you see that impacting your areas?
I can comment at a high level. So we break it down in terms of the way we're thinking about it in terms of actual policy and how that will impact specific industries. So we look at tariffs, we look at corporate taxes, we look at immigration, regulation, social spending, and for each of those, I think the industry impact is different, but you sort of have to break it down into these kind of policy categories in order to come to a specific viewpoint on is it good or bad? Look, Trump election, Harris election, I don't think it is naturally good or bad for the broader ecosystem. You have to look at a specific case in order to understand what it specifically means. And as a broad markets investor, you can say that stocks have gone up under both regimes, and investing with your political bias is not typically a particularly good strategy.
Can I tell you my political bias?
Please.
If Democrats come into play, it's going to be a dark winter, just for a short period of time, to understand what the policies are for the Democrats, for Kamala. If Donald Trump comes in, it's bankers are going to host a lot of fundraisers, host a lot of parties. I think the market is waiting. I think a lot of what I hear, at least with some VC buddies, is they're waiting to see what's going to happen in November. If it's a Democrat, then what happens? Taxes go up, regulations go up. That includes a lot of work to get that. Good for the lawyers, good for the bankers. So we're rooting for a Democrat. So
well, let's recall the president alone doesn't determine policy, right? A lot depends on how the election goes more broadly than it would do whether we elect Trump or Harris.
No, whoever comes in, right? I mean, I have no dog in the race, but I should have. But again, Democrats, that's the mindset in terms of more regulation, more taxation. Republicans, ease of doing business, ease of regulations, ease of everything. So.
Helen, do you have any thoughts?
I do see that, I think it will have an impact on a lot of transactions, not only the capital raise, financing, but also M&As as well. So especially for larger transactions, we have noticed the increased scrutiny on, antitrust, on, so like national security. So I think those all get impacted, depends on, who will be the president. So a lot of deals are right now on hold until they get more visibility, so they know which direction to go.
And that's in line with my view. I'm not going to take a view on the party, but just there's been a lot of uncertainty in markets the past really 2 years. And I think we're starting to get certainty in a lot of places. And this will be one more point of at least we'll know what we have going forward. So should be helpful, at least to that degree. Still want to, anyone in the audience have questions? Yes.
I have 3 questions.
Okay.
First, is there an IPO market coming up in the next 12 months?
Helen.
So, that's one question. Second is, from a take Isera, we're a startup company, 7-year-old, we do Gen AI. Lot of, like, I think,
Vishal.
you're talking about all these investors from NEA,
Yeah.
Lightspeed and all those guys, right? So if you look at it, those guys, when we are in meetings at the investor level or anywhere, right now, they're all like, they don't have any exits. They're getting pressure from LPs. So
Yeah.
very unnatural things are happening at the board. We didn't discuss that at all. Like, I'll give you an example, what happened with inflection, character AI. So right now what happened is all these entrepreneurs who left recently, Facebook, Google, they thought entrepreneurship is a cool thing. They can't wait anymore. They're all going back. They just want a salary job. Like we have like 20, 30 companies, they're all bailing, right? So there's a pervasive behavior going on in Silicon Valley, which nobody's talking about it. Like, startup is going to take 10 years, 15 years.
Yeah.
So these kids who came out of these companies, they're all going back. And that's why you see Google and Microsoft just acquiring the founders, not buying the company.
Yeah. So the today's generation's entrepreneurs, they're not impatient. So they're not looking for 10 years, they're looking for 2 years, like character AI, let me get 2.5 billion and get the hell out. So also what happens, money is so simple, you know this, right? Raising money is so simple that, whatever the valuation is, if you have AI, you're at least worth $1 billion. If you have robotics and AI, you're worth $2 billion with two guys with an idea. Correct. So you're right. There's a lot of pressure. Before you came, the discussion was that no one's seen liquidity since 2021, except for 8 companies in the public markets, right? And private markets in terms of acquisitions, who knows? But to your point, I think there is going to be an amazing amount of companies going out. Doesn't matter who's in what happens in November, just because everyone is VCs want them to push out exactly because they, as you know, there's a 3-year investment cycle. That means a 3 years fundraising cycle. If they don't show anything in 3 years, are they going to raise more money or not? I don't know. I think there's going to be a lot of happening end of the year.
Or Q1, Q2 next year. So we do see increasing pipeline because it has been like 3 years, right? So lack of transactions. So there's, but the company do, I think when they get out, they do want to have a successful transaction. So they do want certain visibilities, and also the larger banks will tell you to wait until you are larger, get larger scale. So they do a larger deal and they get more fees.
I'm not saying I'll give an example that you guys saw at Workday. Like Workday just announced their earnings call.
What
If you're buying a company, this thing, they're buying to buy their stock at $1 billion. Like,
Yeah.
You don't buy a growth company buying your stock. If you're doing that, that means they're just throwing a towel on economy. So that's what I'm asking, like, what you're saying is, if you see what's happening in public announcement, now, Salesforce, Workday, they're not buying any companies anymore. They're buying back their stock. You don't buy, for a growth company, if you're buying back the stock, then you're like Berkshire Hathaway.
Yeah.
Something's wrong.
But they got a lot of cash, right? So they got to do something with it. And if they say they're just going to put $1 billion at 5% at Bank of America, Bank of New York, that's not going to go anywhere. So
Probably doesn't justify their valuation.
Yes.
Christopher, can you tell me a bit about the GDP growth outlook? Because we talked a lot about the interest rates, but what does the GDP look like?
Yeah, great question. So our view is that we get U.S. GDP growth at 3% going forward. So again, like relatively consensus as things go, but that's a pretty healthy rate for a developed economy, and even in the face of high rates.
How do you contrast that to EMEA or Europe?
I don't know off the top of my head where we are in terms of Asia outlook. I probably have it somewhere and I can look it up and hand it over. But Europe, we have a lower number, 2 to 2.5%.
Also, to the previous point about the interest rates, sorry.
No.
I think London or UK and I forgot which other countries reduced the rates ahead of time for US. I think their markets were crumbling and they had to do something. America's market is very strong. So we don't want to do the double dip, meaning bring it down by 7 basis or 3/4 of a basis point, then have to bring it back up because the interest rates the inflation is going up. So patience is very important.
Just wonder anecdotally, in your experience with investors, if you're seeing cooling of the IPO market just because there's other avenues for speculation ICOs or the secondary transactions are two-sided, so maybe you can get your speculation in that.
Sorry, you said, I didn't quite get
There's no
7.
interest in IPOs from investors because there's other avenues for speculation.
Well,
Speculation or liquidity?
Speculation from the investor side.
I mean, the most of the money goes to the Max 7 stocks that you're observing. Yeah, I guess that's also a combination of lack of issuers because there are just not many companies that want to get out at this moment. So if there are, I would say that investors are actually more than willing to buy the IPO stocks. And some of the deals that we see over 40 times oversubscribed, which really drive up the valuation of the IPO. So I wouldn't say that it's necessarily a complete demand issue. Definitely people feel probably, there's benefit of allocating to safer stocks. But I would say there's still, from an investor perspective, there's a demand for IPOs.
Bear in mind that these are long-term trends, right?
Right.
Like we've had fewer publicly traded stocks has been a trend for the last decade, roughly. And part of it's just being a publicly traded company is hard. And when there's these massive pools of capital, it was pretty unheard of a decade ago to think that a venture fund would raise $6 billion, $7 billion, right? Like, those are LBO, those are LBO numbers, right?
From RIAs.
Yeah.
Competing against your business.
There's just a lot of money chasing deals in the private markets, and it leads to all these dynamics that weren't the case previously around like liquidity for founders and early employees, et cetera. Like, but there's a robust marketplace for it.
But I think you do need liquidity for founders because the timeline is, if you worked for Reddit for 19 years, you started when you were 19, now you're 40. You're like, oh shit, I don't have a house. My girlfriend didn't marry me because I don't have a house. I don't have a job.
Employees
I have a job though.
employees demand it.
So,
they expect it.
Yeah,
right.
Exactly. People want to start their, sorry.
No. And in the private fund space, a trend we really see are a lot of continuation funds. So funds are getting towards the end of the life. They have an asset. They don't need to sell it or list it. They can just transfer it to another fund that they form and hold it for another period. So that's, in our neck of the woods, a thing we're seeing that's also putting some pressure away from IPOs.
That's because and I don't know whoever the forefathers were of the venture capital community. I don't know why they did this. 10-year fund cycles, 2 and 20, Monday morning meetings.
We'll talk offline. But we're getting
why Monday? Why not Wednesday?
Well, that's true.
Come on, man.
Oh, yeah. Well,
because they're.
But we're getting to the top of the hour, and I think it's been a really interesting panel. And thank you, everyone, for having questions. Let's finish on. I'll give each of you what's like one top line thing you're looking ahead the next 4 to 6 months. What's your prediction? Your one thing that you see in the next 4 to 6 months before we get to the next year's mid-year capital outlook. So,
I just think there's going to be a tremendous amount of liquidity when it opens up. We're going to see so much companies that are exiting. At least that's my wish.
A lot of IPOs coming back, and M&As as well. So
Let's hope. I hope you both are right. That would be, and my view is fairly consistent, which maybe means we should all question, which is soft landing, actually achieved.
Well, see, Yvonne, we did not make you cry. That was very optimistic.
Very optimistic ending. Yeah.
Yes, good ending.
Yeah, very good. So thank you, everyone, for coming. And, feel free to ask us questions, but, thank you also to our panelists and thanks for the great event.
Well, we should take a photograph for that.
Oh, yeah.
This thing.